I all, as we discussed about the cost of capital under the last week's session, here within this week, we are going to discuss about bond valuation and the stock valuation. Here, first part is bond valuation. Hope you have go through the first session in case of estimation of long-term finance, and now you are having a certain idea about these concepts. Under this section, today I am going to discuss these three areas: key features which is vital to identify under this level, that means under HNDA level, belongs to this particular topic, and way of doing the bond valuation and measuring the yield. Most of the things I discussed in last session also. Here I have put something about the key feature of a bond. The first one is face amount. That means the value which is paid at the maturity. Let's say we are having a bond. Okay, we are having a bond which we have purchased, okay, from a public limited company. When we are purchasing that bond, that particular company has promised to pay ₹1,000 after a certain period. Let's say after 2 years of period. That 2-year period is the maturity period. Maturity period. Then the amount which has been promised at the after end of the maturity period, that means this 1,000 is the face amount, or we are saying that as par value 2. Okay, I think you got the idea. Then another important thing is coupon interest rate. When you are doing these calculations, also the identification of these concepts become vital. Here, coupon interest means the interest rate, okay, multiple by the par value to get the rupees interest. That means in case of here, the par value, in the case which I used earlier, the par value is 100 rupees. Then let's say they are saying that for this certain period, they means the particular company is promising that with this par value they may pay 10% interest per annum. Then that 10% interest which promised by the company is the coupon interest rate of this scenario. Then in here we can calculate the coupon interest by multiplying the par value. That means simply 1,000 in this case by the coupon interest. That means in this example which I used 10%. Then we can get the value of coupon interest as 100. I think you got the idea now. The next concept, maturity. Already I have discussed that part. Then issuing date. date when bond was issued is the issuing date. Default risk, that means risk that the insurer will not make insurer interest or principal payment. That means, as in our example, that particular company has promised to pay 1,000 worth of face amount at the end of maturity period with 10% interest per annum. So there is a probability of missing that. There can be a probability of missing that to the holder. That means sometimes the public limited company may not having the capacity to pay that. Sometimes let's say they can be bankrupt. At that scenario, that type of risk have to incurred by this holder. So that is known as default risk. Simply the risk that issuer will not make interest or principal payments. Okay, I think you got the idea. Then what is called sinking fund? So without wasting time, please go through the content, then you can identify. Then provision to pay off a loan over its life rather than all at maturity, known as sinking fund. It looks like amortization of a term loan you may practice. That reduce the risk of investor, as installment wise they are receiving the principal amount. But in some cases we can say interest rates are declined. At that scenarios, it may not be good for the investors' view. Then this is the important part of this presentation, which we are going to measure the bonds. Here, when it's become financial asset valuation, simply we can use this present value of the future expected cash flows as the market value. Let's say in this example, year 1 we are going to receive 100 worth of interest. Year 2 also we are going to receive 100. Then year 3 we are going to, let's say this is as year 3. So okay. Year 3 we are going to 100. Then this particular bond, if we assume that this is as a bond, if the face value of this bond is 1,000, then end of the maturity period, that means end of year 3 we may receive the particular interest plus the face value 2. Then when we are calculating the market value, what we need to do is we have to calculate present values of these future cash flows, that is equals to the market value. I hope you know how to calculate present values of the future cash flows. You may study these things under advanced management accounting subject. So simply the way have put by me here. This is the foundation of financial assets valuation. Here you can see one particular example with some figures. In here, value of a 10-year bond. Here coupon interest rate is 10%. Okay. Then RD means the discounted factor or cost of this debt also 10%. Then you can see in the example, the face value is 1000. Then value of this bond should be the future expected receivings present value. How did we calculate this 100? It can be calculated by face value into coupon interest rate. Face value into coupon interest rate. Here 10% is the coupon interest rate. Face value is 1000. 1000 into 10%, 100. Okay, as like that, we need to calculate the present value of all these 10 figures. Figures belongs to these 10 years as 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10th year. Then 10th year, you should identify that other than the interest, the investor may receive face value to the 1000. Then we can calculate the value, the cumulative present value, we can known as market value. So it has become as 1000 in this example. Then we can use these equations in case of valuing the bonds. Some bonds they are paying annual interest payments are doing annually. Then in such a situation, you can use this equation simply, or otherwise without going for the equation, simply you can calculate the present value of future expected cash flows. On the other hand, some scenarios are there, they may pay the interest semi-annually or otherwise 4 times per annum, as like that. At that scenario, you have to revise this equation little bit. Here, when interest are going to pay in such a bonds annually, here B0 refers to the bond price. That is what we are going to identify through adapting this equation. C means coupon payment. It can be calculated by face value multiplying face value by coupon interest, face value by coupon interest. Then interest rate here R, it may given, that is the cost of this bond, RD, which we calculated in last session. Then face value you know, T refers to the number of years, that means the maturity period. If the scenario becomes semi-annual interest payments, simply what you need to do is some small changes need to adapted in this equation. The cash flows, that coupon payment value have to be divided by 2. The number of years need to multiply by 2, that means T into 2. then R values have to divide by 2. Here you can see. With these changes, you can get the new equation for calculating market value for the semi-annual bonds. Let's see this example. I will show how to sort out. I got from this from the past paper 2017 question number 5.1. Here, let's go through that. Consider a 4-year debenture with the par value of rupees 100 that pays a 16% coupon annually. An investor who is considering the purchase of this debenture requires a rate of return of 20%. How much is the value of this debenture? Already you know. Simply what we need to do is, one way is simply we can calculate the present value of these expected cash flows, or otherwise we can adopt the equation which we discussed earlier. As in this example, they are going to pay annual interest. We have to go for this particular equation. Let's see. First, I will adopt the first method, calculating the present values of the future expected cash flows. Here, let's identify. Considering 4-year debenture with par value is 100. Coupon interest rate is 16. Coupon interest rate is 16. Then that means annually they are going to receive 100 into 16%. That means rupees 16. That is the coupon interest which they are going to receive annually. Year 1, 2, 3 and 4. Let's draw. Tableize that. We can use years. Then cash flow, cash receivings. Year 1 they are going to receive the 16 coupon interest. Year 2 they are going to receive the 16 coupon interest. Year 3 they are going to receive the 16 coupon interest. Year 4 they are going to receive the 16 with the face value. Face value is 100. Total, if you want, 160. Then when it's become the present value calculation, you know that we have to identify the discounted factor. For that, requires rate of return has been given. Simply this is the cost of this bond which we calculated last session. Cost of this bond. By using this cost of capital, cost of this bond, we can develop the discounted factors in case of calculating discounted cash flows. For simply you can adopt what? 1 divided by 1 plus Rn. Okay, hope you have studied these things. Then year 1 it may 0.833. Year 2 year 2 it may have 1 divided by 1 plus 0.2 n equals to 2. That means 0.694. Then here you just calculate, huh? 0.579, then here 4, 0.482. Then you can get discounted cash flows. Discounted cash flows, year 1, cash flows multiplied by the discounted factor, year 1, 13.33, year 2, 11.10, year 3, 9.26, year 4, 55.19. Then you can get the total value, that is the present value. That means B0 market value is, just get the equation, total 89.60 with the bond value. Same one can be solved by using this equation which we discussed earlier. 2. Then equation is, as this is the annual interest payment scenario, B0 equals C1 minus 1 plus R power minus P divided by R. Okay, then plus present value of the face value F divided by 1 plus R power P. Okay, here let's adopt C equals to cash coupon interest 16, 1 minus 1 plus R refers to the cost of debt capital or required rate of return. It's about 20, then 0.2 minus maturity period is, oh my god, maturity period is 4 years divided by 0.2, that means 20% cost of capital or required rate of return, plus here face value has been given as 100 divided by 1 plus 0.2 years. Then you should be careful really when solving these types of equations using calculator. First of all, I am recommending, I will show, it's better go to this part first. That means minus power 4 value of 1.02. Then in the calculator, you can deduct that answer of this part from 1. Okay. Then that answer, this answer can divide by 0.2, okay, then it can multiply by 16, then answer may be 41. Then it may easy here, you can go for the part, that means 1.02, no, 1.2 power 4 value you can get, then 100 can be divided by that answer, may around 48.23, then our answer rupees 89.23, 89.23. Both the answers are looks like same, other than some decimals can be changed because of the conditions with decimals. Okay. Then some concepts I have discussed here. Yield to maturity, that is the rate of return earned on a bond held to maturity, also called as promised yield. This is what we discussed as cost of capital 2. So it's same. YTM, or yield to maturity, is the discount rate that makes the present value of future cash flows equal to the price of the bond today. It assumes the bond will not default. Then here the summary of calculating semi-annual bonds. Multiply the, I already explained these things, so you can go through those. Then same types of questions you can see in past papers. I have listed some of those questions, and here I discussed 2017 one, I think. Then others you can test. If you need support, you can ask them from your particular department. Okay, now let's move to the next presentation. Here we are going to discuss, already we discussed about bond valuation. Here we are going to discuss about stock valuation. Under this, we are going to discuss about ordinary share valuation and the preference share valuation. Other than this valuation, here I have entered some additional parts also for your further reference. It's better go through those and you can read it. All the things no need to be explained, but I have put those for your further readings. Already you may discuss about the features of the common stocks, which gives the ownerships to the ordinary shares. Simply ordinary shareholders are giving the ownerships to the bondholders, shareholders. That is the specialty of the ordinary shares. You have studied these features in your first year and second year, so I am not going to discuss those. And also the agency relationships also you may discuss. Then initial public offerings, you may know these things. For your additional knowledge, I have put these things. A firm goes public through an initial public offering when the stock is first offered. Stock is first offered. That is known as the first offering, known as initial public offerings, IPOs. Prior to an IPO, that means initial public offering, shares are typically owned by the firm's managers and key employees, and in many situations venture capital providers. But after start this process, the public may own those shares as It's going to trade in the financial markets in the Colombo Stock Exchange. Yes, just go through about this process. It may interest. Okay, no need to be in the boundaries. Okay, just read more and more and collect those data. Then it will be important any of the day. Then seasoned equity offerings. You can go through these notes also. A seasoned equity offering occurs when a company with public stock issues additional shares after IPO or SEO. The stock trades in secondary market, that means in the Colombo Stock Exchange. So you can refer, I am recommending to read these things: reasons for a share valuation, concept of share valuation. There are so many theories are there. So some recommended books which I identified also have been put here. You can go through those also. And in addition to that, our main reference books also there. I.M. Pandey's financial management book, especially those things you can read out for additional knowledge. Here what we are going to discuss earlier this today's session, this video session, I discussed how to value the financial assets by using the present value of future cash inflows. Here also, when it's become valuing shares, we can use these methods. Some of these we are going to discuss here under this chapter: asset base, earnings base, cash flow base, dividend base, and so many things are available. To go to the existing literature, you can identify so many things. Then first, the net assets method. It's really simple way. You can calculate the value of a share by dividing net tangible assets by number of shares. Here, net tangible assets can be calculated. Net tangible assets can be calculated. I think you know. Net tangible assets can be calculated. Total assets minus intangible assets. Intangible assets minus total liabilities. This is the way of calculating net tangible assets. Keep in mind the term net. That's why we deduct the total liabilities. Then PE ratio method also there. Normally you may study these things under ratio analysis sections. So PE ratio equals to the market value of a share divided by earning per share. From that we can get the value of market value of shares. How? PE ratio multiplied by earning per share. Then here one example available. Company, you have been given information of a company, then you ask to calculate the value of a share using net assets method. Simply, as you are aware, value of that can be calculated. How? Value of a share, as we discussed earlier, value of a share equals net tangible assets should be divided by number of shares okay, then net tangible assets divided by number of shares. Then here net tangible assets you can identify as here no any intangible assets. No need to consider intangible assets then here. Then total assets here, fixed asset plus current assets, fixed assets plus current assets. As no intangible assets, there are no need to deduct, consider that. Then we need to deduct the total liabilities. Okay. Then number of shares you have been given 70 million. Then you can get the answer. Okay. I think it's easy. Then this is the way which is highly used in, as we use present value of the future cash flows in case of valuing the bonds. Here same method can be used to value in the ordinary shares also. Here, as we received interest for dividends, we may receive interest for the bonds, we may receive dividends for the ordinary shares. So present value of future expected dividends can be equal to the present value of the net market value of the particular share. Here you can see if a firm is expected to pay dividends of ₹20 per year to infinity, and the rate of return required on share of this risk class is 20%, that means cost of ordinary share 12% discounted factor or otherwise, then we can calculate present value. I think you may have in last class, under last session, under the cost of capital, we used this equation to get the KE. How did we do that? Cost of ordinary share capital, KE equals D1 divided by P0. Okay, here we are going to calculate P0. Okay, from this concept we can develop this idea, we can develop this equation. Then under this method, that means when we are going to receive dividends, same dividend for infinite period, we can use this equation to calculate the market value of that particular share. Simply that dividend, which is not going to change for infinite period, should be divided by cost of equity. I think you got the idea. Then here another one, single period valuation, another way of calculating, another case or scenario. Let us assume that investor intends to buy a share and will hold it for 1 year, just for 1 year. Share කොටසක් ගන්නවා ඒක අවුරුද්දක් තියාගෙන ඉන්නවා. Just share hold that for 1 year. Suppose he expected to pay a dividend of rupees 2 in next year. For that particular period, 1 year, he is going to receive a dividend of rupees 2. Then at the end of the period, 2 years period, he or she, that holder, can sold this for 21. After 2 years, market value becomes 21 rupees. If the investor's opportunity cost of capital or the required rate of return or simply the discounted factor is 15%, how much should be paid? In this scenario, as we can identify the number of years, as we can identify the relevant cash flows, it's simple. We can go for simple finance assets valuation method which we discussed. That is what? Use the present value of future cash flows. Okay, here this is going to hold a 1 year. Today we are going to invest. This is number of years. Then after 1 year we are going to sold out this. This 1 year we may hold this. Okay, after 1 year we may receive 2 rupees dividend. Okay, dividend of 2 rupees. We may receive dividend of 2 rupees. We may receive dividend of this 2 rupees plus. In addition to that, we can sell this share for 21 in the market selling price. කොටසෙන් රුපියල් 2ක් ලාභාංශ එනවා 21කට විකුණලා ගන්න පුළුවන් වෙළඳපොළ වටිනා. So simply, if we sold this in the market and if we received this dividend, total 23 may receive by us. So today's market price can calculate simply. We need to calculate present value of this cash flow. That means this 23. Then present value equals 23 divided by 1 plus R. R has been given 15%, 0.15. N means 1. Just hold in 1 year as. Then you can get the answer. Answer will be, you just calculate rupees 20. Just check whether my answer is correct or wrong. I think you got the idea here. Then under the cost of capital, we discussed the dividend growth model. I think you may remind. We used here also. Same scenario can be there. Earlier one, which is what was happened earlier. Earlier our dividend is not going to change for infinite period. We are going to receive same dividend. But when it become a dividend, this scenario, our dividend is going to increase from a certain rate for an infinite period. At that time, okay, if we go to the main concept of the dividend valuation, I think you may remind the way of calculating the dividends when there is having a growth rate. I discussed those things, how to calculate D1 equals D0 1 plus G. Then D2 equals D0 1 plus G power 2. You may remind that. Oh, otherwise D2 equals D0 1 D D2 equals D0 1 plus G into 1 plus G. We discussed these things. Okay, hope you may remind those things. So here also, if we adopt same method, that means the valuing method of financial assets, simply what we need to do is calculate in the present value for this calculated dividends. Okay, but as it is for infinite period, it may some problems can be arise. Then same model which we used in last session in calculating cost of capital and dividend growth model can be adapted here also. Let's see here all these things I have discussed. Then under here we can go for this equation. If our dividends are going to increase by a fixed rate for infinite period, market value of the particular share can be calculated by using this equation. Okay, let's use an example. Here we have been given D0 2 rupees. Cost of this ordinary share is 13%. That means required rate of capital. Then growth rate is 16%. Even I taught to you how to calculate this G also. Okay, so we can use this equation for calculating this market value of this particular share. Then P0 should be equals to D0 have been given as 2, then 1 plus G equals to 6%, that means 0.06 divided by RS, cost of ordinary share capital, which can be calculated in last session, 0.13 minus G 0.06. You can calculate by using the calculator. Answer may be here D1. You can get value for D1. Answer for this part 2.12 divided by 0.07. Answer is rupees 30.29, the market value. Then here the today's market value. Okay, today's market value. Then what will happen? We can identify market value after a 1 year. Here we calculated P0, but we can calculate P1. At that time, what we need to do, as we are going to calculate P1 here, when we are calculating P0, we consider D1. So we can revise the equation. When it's become P1, that means market value after 1 year, you can calculate how D1 should be divided by RS minus G. So as like that. When it's become P2, you have to go for D. No, not D1 here, it should be D2. When it's become P3, it should be P2, it should be D3. When it's become P3, it should be D. I think you got the rationale. Okay, here you can see the way of calculating the answer. Then in this particular example here, we after a 1 year, okay, after a 1 year, we are going to receive a dividend, okay, we are going to receive a dividend. After, let's say, we invested this P0, that is the market value which we identified in earlier. Then a dividend, by investing 30.29, we are going to receive a dividend of 2.12, which we calculated earlier. We can calculate that. Okay, here D2, D1, D2 you can calculate. See, D1 we identified 2.02, we can calculate. How to calculate D1? This can be calculated D0 into 1 plus G. Okay, then to earn this 2.12 dividend, investors should invest 13.29. For as a rate, it's about 7%. That is known as dividend yield. Okay, that is known as dividend yield. Okay, then end of the we invested. Okay, we invested. That means we have to incur, as market value is 30.29. We have to invest 30.29 to purchase this particular share. After 1 year, we may receive 2.12 dividend, plus market value also going to be changed. Market value also going to be changed, as after 1 year 32.10. We are going to, if we wish, we can solve this particular share in the market for 32.10. We calculated this one earlier. Okay, in here, this change of market price, this benefit we known as capital gain yield. So in that, it can be calculated as a percentage. This is what we invested, and after 1 year, this is what was happened to our market value. That means P1 minus P0. So that's about 6%. So total benefit we can get dividend yield 7% and the capital gain 6%, then total about 13% receiving. That means that's a cost for that particular institute or company. That is the cost of capital. From the invested side, that is their total return. Then total return you can identify: dividend yield 7%, capital gain 6%, 13%. That is the one which we identified as RSO. We calculated this one under cost of capital session also. I think you got the point. Here also you can see in all these examples, we use R value as 13%, RS 13%. That is the, I think now you are having an idea. Sometimes these things can be little bit confused, but you have to read more and more, do more and more calculations. You can see some examples here also. Here you can see some examples. I am not going to do these things as we discussed. If the last year dividend was paid D0, next year due to 1 year, and all these things information have been given. Simply what you can do is adapt this equation. You have to identify the D0 values and D1 values from the given information, and then you can identify this value. Okay, just to go through the sum as I discussed these things. In last class, I discussed how to calculate G. All these things have been inserted in this one also. Then you can go through. Please, if you not remind these things, I discussed one sum regarding how to calculate this G. Please go through that. Then you can do this one also. You can do simply you have to adapt. You can identify D0 and you can identify the G growth rate and you can identify the cost of ordinary share. Then simply use this information. Then you can calculate P0 by adapting dividend growth model. Then supernormal growth stock, it's another way, another method. In here what is going to happen is, for a certain period we are going to have different growth rates in our dividends. But in dividend growth model, you may remind that we received what? Constant growth. But here, for a certain period, for 1 or 2, we are going to have a different growth rate. But after that particular period, again, the growth rate going to be constant, let's say. Supernormal growth of 30% for 3 years. That means within first 3 years, our growth rate is to be 30%. Then long run, it becomes constant 6% as like that. Then at that scenario, what we need to do is we have to calculate the dividend which is going to receive in year 1, year 2 or year 3. In this example, for first 3 years, we are going to receive, we are going to have a dividend growth of 30%. So adapting D0 equals to 1 plus G equation, you can calculate these dividends which are going to receive. Then after this year, okay, after this year, it's going to be, the growth rate is going to be constant. Okay, then what we need to do is, if we have to identify the market value other than this dividend, we have to identify the market value of this share after that particular constant, the particular super growth rate period. ඒ කියන්නේ growth rate එක වෙනස් විදිහට වැඩි වෙන period එකෙන් පස්සේ constant උනත් දවස් උන තත්ත්වයේ ඉඳන් අපි හදා ගන්න ඕනේ market value එක. ඒ කියන්නේ මේකේ නම් තුන්වෙනි අවුරුද්දේ අවසාන වෙනකොට market value එක අපි හදා ගන්න ඕනේ. In that case, simply we can adopt the dividend growth model as the growth rate is going to become constant after 3-year period. Okay, here first year 30, second year 30%, third year 30%. After third year, it's going to 6%. Then it is P3. P3 we need to calculate. For that, what we need to do, we have to identify P3. If it is here P3, we need to identify D4. Here G is 0.06. The equation which we adopted earlier, here K E. Then you can get this value. Okay, that means after a 3-year period, if we sold out this share in the financial market, we can receive 66 rupees. 66.53 rupees. Okay, then as we have to use here the financial assets valuation base, that means the present value of future cash flows. Then we have to calculate present value. If we sold this for 66 rupees, definitely we may receive 66. What about the present value of that? That is, you just calculate present value. Okay, here also, here in year 3, what is our assumption? Year 3, we may receive dividend of this 4.394, get the present value of that also. Here also keep in mind, year 3, we are receiving this one also in year 3. Here we just identify this 4.561 to get the D4. හරි එතකොට මේ තුන්වෙනි අවුරුද්දේ අපිට දෙවර්ගයක් ලැබෙනවා ඩිවිඩන්ඩ් එකයි මේක විකුණලා ලැබෙන සල්ලි කියලා විකුණුවොත් ලැබෙන ගාණයි. So we need to identify the present value of this market value plus the dividend. Then year 2 we have received the dividend, get the present value of that also. Year 1 also we have identify what is going to happen, we going to receive as a dividend, get the all the present value of these cash flows. Then you can get the total, that is the P0 of this particular cash, particular ordinary share, which is going to have supernormal growth. So I told you to refer something about the issues with dividend growth model. Here I have inserted something. For these things you can refer, and also some suggestions for your reference also I have put. Then let's move to the concept of the preference share, preference stock, how we are going to calculate preference stock. We discussed something about cost of preference shares in the last class also. Here under the valuation of the stock also, we are going to have a discussion about value in the preference stocks. It is easy. Earlier you may remind how to calculate the cost of the preference share. So earlier we used cost of a preference share can be calculated. That means in last session we discussed RP, cost of preference share, equals to dividend which we are going to receive divided by P0. Here P0 if we consider as V, value of preference share, we can identify that value. Okay, what is our equation? How to calculate annual VPS, how to calculate dividend, okay, divided by RP. That means dividends that which we are going to receive through these preference shares should be divided by cost of preference shares. Okay, then value we can get. This is what we did in last class, so nothing to study more. It's simple. Just use the knowledge which we earned through last video session. So here also you can go to some past paper questions. I think it's better go through these questions and identify how to solve different types of questions. Okay, I think you may having so many problems within this session. That's true. through online mode, it's difficult to discuss all the things, but it's better having a discussion with your ATI lecturers and use this material, read furthermore reference materials, then you can gain this knowledge easily. Thank you.